Listen, folks. It's January 2026, and the market is already putting on its usual show. The S&P sits at forward multiples around 22 to 24, the Shiller CAPE near 40, and every feed you open is flooded with screenshots, 50%, 100%, 200% gains on the latest AI breakout. Nvidia surges again, some smaller semiconductor play doubles in days, and suddenly everyone seems to be getting rich except you. That sharp, burning sting you feel right now, that's envy. And let me tell you something I learned over nearly a century. Envy is the stupidest sin of all, and it will destroy your portfolio faster than any bear market ever could. Envy is the stupidest sin, and it will bankrupt you faster than any crash. Picture this, it's January 2026, and your social feeds are on fire. Screenshots everywhere, friends, strangers, anonymous accounts boasting 50%, 100%, even 200% gains on the latest AI breakout. Nvidia surges another leg higher. Known semiconductor name doubles in days. And suddenly the world seems to be printing money while your portfolio sits quietly. That sharp, burning twist in your gut, that is envy, and Charlie Munger identified it as the single most destructive force in investing. Envy does not merely cloud judgment, it systematically dismantles discipline. The instant you witness someone else's rapid windfall, the rational part of your brain goes silent. You abandon your circle of competence. You chase unproven narratives. You overpay for momentum stocks trading at nosebleed multiples, 45 die, 50 die earnings, sometimes more, because the pain of watching others win feels worse than the risk of losing your own capital. You justify stretching valuation, borrowing to keep up, abandoning patience, all because if they can do it, why can't I? In 2026 environment, where artificial intelligence's enthusiasm has already propelled certain leaders to trailing PDs in the high 40s and forward estimates still reflect explosive growth. This behavior will be epidemic. The crowd piles in, pushing prices higher, and the latecomers, driven by envy rather than analysis, become the ones left holding when sentiment reverses. Munger's antidote was brutally simple. Never let someone else's quick gain dictate your actions. He reminded us that markets are designed to separate the patient from the impulsive. The investor who envies rapid windfalls often ends up overexposed to speculative froth, forced to sell at the worst moment when reality reasserts itself. True wealth, he argued, comes from ignoring the noise, sticking to high-quality businesses with genuine moats, and accepting that your path will look boring compared to the speculators' flashing paper profits. Social proof is powerful, but it is also a mirage that lures people into overpaying for mediocrity or outright illusion. In an era of instant gratification, endless comparison and algorithm-fueled highlight reels, envy feels like the default emotion. The greatest competitive advantage you can cultivate is indifference to others' short-term success. Focus on what you truly understand, buy excellence at reasonable prices, and let compounding, not comparison, do the work. The moment you stop measuring yourself against the crowd's latest winners, you reclaim control over your decisions. That quiet discipline, not the loudest gains, is what separates enduring success from fleeting excitement. Once you master this, the market's distractions lose their power, and the real opportunities, the ones built on patience and rationality, become unmistakably clear. Envy is a thief that steals more than money. It steals judgment. Starve it, and your future self will thank you. The crowd's gains are a mirage. Don't chase them. As January 2026 unfolds, your social feeds are a battlefield of bragging screenshots of 50%, 100%, even 200% returns on the latest AI breakout flood every platform. NVIDIA powers higher. A lesser-known semiconductor played doubles in days, and the narrative is deafening. Everyone seems to be winning big while your portfolio remains quiet. That sharp, gnawing feeling is envy's cousin, the fear of missing out. It whispers that the action is elsewhere, that sitting still is the real risk. Charlie Munger would dismiss the spectacle with a single, cutting observation. Those flashy gains are often a mirage, and chasing them at peak euphoria is one of the most reliable ways to end up holding the bag. The illusion is powerful. Social proof amplifies every success story, making the crowd's momentum feel like the only path to wealth. Investors convince themselves that if others are profiting so handsomely, the opportunity must still be valid. They rush in, overpaying for momentum stocks at nosebleed multiples, $45, $50 earnings, sometimes more, because the pain of being left behind outweighs the risk of being wrong. But mirages vanish when reality arrives. When earnings disappoint, when competition intensifies, when policy shifts introduce friction, or when simple mean reversion takes hold, the gap between perception and fundamentals snaps shut. The latecomers, the ones who chase the crest of the wave, find themselves underwater as sentiment reverses. The premium they paid evaporates, turning yesterday's paper riches into permanent losses. Munger understood this cycle intimately. He watched generations fall for the same trap, from railroads to .coms to every speculative frenzy since, and warned that bubbles are not fueled by greed alone, but by collective delusion. The people who buy the hottest story at its most expensive moment rarely recover. They become the cautionary tales. In 2026 environment, where artificial intelligence enthusiasm continues to inflate valuations and social feeds scream success, the temptation to join the parade is overwhelming. Resist it. The disciplined investor recognizes that true opportunity lies not in riding the wave of hype to its peak, but in waiting for the froth to subside and entering quality businesses at reasonable terms. Chasing the crowd's gains does not secure wealth. It guarantees you arrive just in time for the fall. The market rewards patience, not participation in the euphoria. Once you see the crowd's victories for the temporary illusions they often are, the choice becomes clear: step aside, stay sober, and let compounding work in silence while others chase shadows. That restraint, not boldness, is what separates survivors from casualties in times of volatility. Envy turns rational people into fools overnight. Imagine scrolling through your feed on January 3rd, 2026. A friend posts a screenshot of 150% gains on the latest AI breakout. An anonymous account flaunts a triple on a semiconductor name that doubled in a week. and influencers everywhere declare the bull market unstoppable. That sharp, twisting sensation in your chest is envy, and Charlie Munger would tell you it is the single most dangerous emotion in investing, capable of transforming even the most disciplined mind into a reckless one in seconds. The moment envy takes hold, logic retreats. You begin to question your own strategy. Your carefully built portfolio, focused on quality businesses at fair prices, suddenly feels inadequate compared to the fireworks others are experiencing. The pain of missing out becomes unbearable. Rational thought evaporates. You abandon your circle of competence, convinced that if others are profiting so handsomely, the opportunity must still be valid. You chase momentum stocks at nosebleed multiples, $45 to $50 earnings, sometimes higher, because the fear of being left behind outweighs the fear of being wrong. You stretch valuation, borrow to amplify exposure, and justify every decision with the same dangerous phrase. If they can do it, why can't I? In 2026 environment, where artificial intelligence enthusiasm has already driven certain leaders to trailing PTIs in the high 40s, and forward estimates continue to project explosive growth, this behavior will be widespread. The crowd piles in, inflating prices further. And the latecomers, driven by envy rather than analysis, become the ones left holding when reality reasserts itself. Munger understood this dynamic with piercing clarity. He watched generations fall for the same trap, from railroads to dot-coms to every speculative mania since, and warned that envy blinds investors to the simple truth. The big money is not made by joining the parade at its loudest moment. It is made quietly through patient ownership of exceptional businesses that compound value over decades. Envy thrives on comparison. It feeds on the illusion that someone else's short-term paper profits are a measure of your own worth. It pushes you to overpay, over-leverage, and overstay your welcome. The result is predictable, the envious chase. The crowd's gains arrive at the peak and suffer the sharpest fall when sentiment reverses. In an era of instant gratification, algorithm-fueled highlight reels, and endless social proof, envy feels like an inevitable force. Yet the greatest competitive advantage in investing is the deliberate choice to ignore it. Focus on what you truly understand. Excellence at reasonable prices. Let compounding, not comparison, do the work. The instant you stop measuring your progress against someone else's temporary success, you reclaim control over your decisions. That quiet discipline, not the loudest gains, is what separates enduring wealth from fleeting excitement. Once you recognize envy for the thief it is, a thief that steals judgment before it steals capital, the path to rational action becomes unmistakable. In 2026, when the market will tempt you at every turn, the investor who masters indifference to others' short-term wins will be the one who looks back years later and smiles. The envious chase shadows. The discipline captures substance. Selling in panic guarantees you miss the recovery. As January 2026 begins, the market is already showing its teeth. The S&P 500, trading at forward multiples around 22 to 24 with the Shiller CAPE ratio near 40, feels stretched to many observers. AI enthusiasm has carried valuations to dizzying heights, but the first real crack, whether a disappointing earnings whisper, a surprise policy shift, a rotation out of mega caps, simply a 10 to 15% pullback triggered by profit taking, will arrive without warning. When it does, fear will flood the system. Most investors will react instinctively. They will sell. They will hit the exit button at depressed prices, convinced the sky is falling, locking in losses just as the cycle prepares to turn. Charlie Munger would watch this spectacle with weary recognition and deliver the same blunt verdict. He always did. Panic selling is one of the most reliable ways to destroy wealth. The psychology is brutally simple. A sudden drop feels like confirmation of every worst case scenario. The headlines scream, correction. Social feeds fill with doomsday predictions. And the visceral pain of seeing account balances shrink triggers a primal urge to stop the bleeding. Investors convince themselves that preserving what remains is wiser than enduring further pain. They sell quality holdings, businesses with genuine moats, strong cash flows, and proven compounding ability at prices far below their intrinsic worth. In doing so, they crystallize temporary paper, losses into permanent capital destruction. The cruel irony is that markets have always recovered from legitimate pullbacks. The companies that survive volatility and emerge stronger are precisely the ones that reward those who hold through the storm. Yet, most cannot tolerate the discomfort. They exit at the bottom, miss the rebound, and watch from the sidelines as prices climb back to new highs, often without them. Munger understood this trap intimately. He frequently pointed out that volatility is the price of admission to long-term compounding. Great businesses do not become less valuable because the market has a bad quarter or a bad year. Their intrinsic worth, rooted in durable competitive advantages, consistent earnings power, and disciplined capital allocation, remains intact. The investor who sells in fear surrenders that compounding engine at the worst possible moment. He hands his shares to someone calmer, someone willing to endure the turbulence, and often repurchases them later at significantly higher prices. The emotional cost compounds into financial cost. Studies of investor behavior consistently show that the largest permanent losses come not from market crashes themselves, but from selling at depressed levels and failing to participate in the subsequent recovery. In 2026 environment where AI-driven optimism has inflated expectations and any disappointment could trigger sharp reversals, the pressure to sell will be immense. A single headline about regulatory scrutiny, a slowdown in AI CapEx, or a rotation toward value could spark widespread liquidation. The disciplined investor resists that impulse. He recognizes that volatility is temporary, while the quality of exceptional businesses is enduring. Holding through drawdowns requires no genius, only the courage to ignore short-term noise and trust in the long-term arithmetic of compounding. The market has rewarded patience time and again. Those who stay invested in quality during periods of fear capture the full upside when sentiment inevitably improves. Selling in panic does not protect capital. It guarantees you miss the very recovery that would restore and grow it. Once the temptation to flee is reframed as the costliest mistake, the decision to remain steady becomes not just rational, but almost inevitable. In times of turbulence, the greatest act of discipline is simply refusing to run Da's own businesses without moats and watch your capital disappear. As January 2026 unfolds, the market remains captivated by the promise of artificial intelligence, with leading semiconductor and infrastructure names trading at trailing multiples in the high 40s and forward estimates still projecting explosive growth. The temptation to chase undervalued opportunities is strong. Stocks that appear cheap on surface metrics like price to earnings or price to book. Yet Charlie Munger would dismiss this pursuit with characteristic bluntness. Cheap today does not guarantee cheap tomorrow, and the absence of a genuine economic moat turns even the most attractive looking bargain into a slow, bleeding trap. The mistake is deceptively simple. An investor drawn to a low multiple commits capital to a company that lacks meaningful barriers to competition. No powerful brand that commands premium pricing, no network effects that strengthen with scale, no switching costs that lock customers in, no patents or regulatory protections that deter newcomers, no economies of scale that deliver unassailable cost leadership. Without these structural advantages, profitability erodes as rivals flood in, margins compress, and returns on capital dwindle to mediocrity. What began as a perceived bargain becomes a value trap. Time quietly dismantles whatever temporary discount existed, leaving the investor stuck in a cycle of disappointment and opportunity cost. The low multiple was never the point. The absence of a moat sealed the outcome from the start. Munger insisted that durable economic moats are the foundation of lasting wealth. These rare advantages, whether a dominant brand, network effects, high switching costs, intellectual property barriers, or overwhelming scale, shield profitability across cycles. In 2026 environment of heightened scrutiny and potential volatility, where AI narratives could face reality checks and policy shifts introduce friction, only businesses with genuine fortresses endure. Companies that can raise prices without losing customers, repel imitators, and reinvest capital efficiently are the ones that reward long-term ownership. Paying a fair premium for such a fortress allows high returns on capital to compound relentlessly, rendering the initial cost incidental over time. Ignore the moat in favor of a depressed multiple, and the investor is left defending a position with crumbling walls. The market will perpetually offer distractions, temporary dips that feel irresistible, overhyped stories that give us quick riches, and apparent bargains that seem too good to pass up. Resist the urge. Redirect attention from surface level pricing to underlying durability. Seek enterprises with real economic fortresses, those capable of sustaining superior returns across decades, not just quarters. These businesses require no bargain, bin discount to deliver exceptional long-term outcomes. The disciplined investor recognizes that genuine opportunity resides not in buying low, but in owning excellence that time cannot erode. Once moats take precedence over multiples, The logic of enduring fortunes becomes unmistakable. They are built not on fleeting discounts, but on barriers designed to last. In a year that promises turbulence, the greatest edge is owning what others cannot easily replicate. The big money is boring, brilliant. As the first trading days of 2026 begin, the market pulses with the same intoxicating energy that has seduced investors for generations. The S&P 500 trades at forward multiples around 20 to 24. The Shiller CAPE ratio hovers near 40, and artificial intelligence enthusiasm continues to fuel premium valuations across technology and semiconductor leaders. Everyone wants the secret formula, the perfectly timed trade, the next macro call, the hot thematic bet that will make them look like a genius. Charlie Munger spent nearly a century watching people chase that mirage and reached a stark conclusion. Extraordinary returns are rarely the product of extraordinary intelligence. They are the quiet, almost to monotonous result of owning wonderful businesses at reasonable prices and then doing absolutely nothing foolish for decades. The seduction of brilliance is powerful. Traders scan charts for the ideal entry, rotate into the latest thematic plays, and convince themselves that one perfectly timed move will change everything. Yet the graveyard of investing is filled with those who tried to outsmart the market. They overtrade, racking up commissions, short-term taxes, and emotional exhaustion. They react to every headline, sell in fear during pullbacks, and buy greedily at peaks. Munger rejected that path entirely. He understood that sustainable wealth is built through the unglamorous arithmetic of high quality. Compounding, owning companies that can consistently reinvest capital at superior rates of return, protected by genuine moats, and managed by capable, honest stewards. In 2026, when volatility inevitably arrives, perhaps from earnings shortfalls, surprises, or simple mean reversion after years of multiple expansion, the temptation to seek shortcuts will be overwhelming. Resist it. The real edge lies in boredom. Buy excellence, pay a fair price, even one that feels slightly stretched in the moment. Then sit on your hands. No constant monitoring, no frantic adjustments, no reacting to every whisper of disappointment. Let time and the inherent power of a great business do the heavy lifting. A company earning 50-20% on capital over 30 years turns a modest initial investment into something remarkable, not because you were brilliant at entry, but because you were disciplined enough to stay invested. This is the hardest part for most people, accepting that success looks ordinary. No flashy trades, no viral predictions, no overnight riches, just steady, rational ownership of quality year after year. Berkshire Hathaway's extraordinary record was not built on genius timing or secret formulas. It was built on patience, rationality, and the courage to be unexciting when everyone else was losing their minds. In a world obsessed with speed and spectacle, that quiet discipline remains the ultimate competitive advantage. The market will always offer distractions, temporary dips, overhyped stories, apparent bargains. But the discerning investor understands that genuine opportunity resides not in buying low, but in owning excellence that time cannot erode. Once the pursuit of brilliance is replaced by the commitment to consistency, the path to enduring wealth becomes remarkably clear. In a year that promises turbulence, the greatest act of mastery is simply refusing to complicate what works.